Good morning and welcome to the ARTEMIS Alpha Trust PLC investor presentation. Throughout this recorded meeting, investors will be in listen-only mode. Questions are encouraged, can be submitted at any time via the Q&A tab situated in the right-hand corner of your screen. Simply type in your question and press send. The company may not be in a position to answer every question received during the meeting itself. However, the company will review all questions submitted today and publish responses where appropriate to do so. Before we begin, we'd like to submit the following poll. I'd now like to hand you over to Kartik Kumar, Fund Manager. Good morning, sir.
Hi there, good morning. Thank you for your interest today. I wanted to take the opportunity to provide you with a recap on performance last year, changes that we've made to the fund, current positioning, talk about how we view the macro right now, and then also look through some examples of holdings we have to give you an insight into our thinking. I have a lot more slides here than we potentially have time to go through, so in parts I'll be quite quick. And then also save time for Q&A to address any questions you have. So just starting off, I'm the lead manager on the fund. I run it alongside John Dodd. We both have significant shareholdings in the trust. I increased my holding in the trust by 27,000 shares in the last year. And if I were to look at 2023, so 2021 and 2022 were really quite difficult, a combination of tough markets and to be candid, I think we made certain mistakes, stock picking mistakes. And 2023 was encouraging, I'd put it that way, no more than that. Encouraging in terms of there was a recovery in performance. The net asset value rose by 17%. And that was well ahead of the all share index that rose 8%, or the FTSE 250, which I think was a bit weaker than that. And I guess my message on performance is, really look at it in terms of having had some very strong years, having had some weaker years, aiming for a more consistent and better outcome going forward. And I think our portfolio is positioned in a way that would enable us to achieve that. So just looking at the performance, this chart shows you the effect. Diamond shows you the price change. The bar chart shows you the contribution in the year. You can see we had a number of holdings that performed really quite well. Our airline holdings responded well to their earnings, rising significantly. Market consensus earnings rose consistently through the year. You can see our interest rate sensitive positions in house builders were a positive contributor. And then our largest position in Fraser's Group, which I'll touch on later, continued to be a strong performer. I guess the other thing to point out here is our technology holdings were also pretty helpful in the year. So Alphabet, Nintendo, and Meta contributed about 4% to the company's performance. Alphabet and Meta were positions that were only initiated in the last quarter of 2022. In some senses, I think looking at last year's performance, the detractors are more important because that's really what held back performance, I think, being going quite a lot further to reversing the underperformance in 2022. So if you look on the left-hand side, our positions in food delivery, which we've owned prior to the pandemic, that effectively did very well and subsequently have done very badly, detracted about 3% from performance. My opinion is we made certain mistakes in our analysis. The barriers to entry are lower than we perceive them to be. However, the market is effectively pricing that industry to not generate an economic return, which is not what we think, with our knowledge, is likely to happen. And so we've continued to hold those positions, and we think the prospective returns are very compelling. Hornby is one which we bought in 2016, effectively when it was required a refinancing. That is a liquid, so I take its share price movements with a pinch of salt. But it did underperform operationally last year, entered into the year with an overstocked position. And that's when its balance sheets deteriorated. The company's taking actions to address this. And I think there are a lot of strategic things it could do to unlock value quite rapidly. So most notably, that is a company with some very strong brand assets, but has no real retail distribution presence in the UK. Whereas if you were to look at something like Games Workshop, building out its retail presence, direct retail presence, has been a very significant factor in driving its revenue and earnings. Then just looking in terms of what we did in the year, so perhaps starting with what we trimmed or sold. So we trimmed our position in Dignity. We rolled over about 2/3 of our holding into Casino. but we reduced the holding, not because we didn't think the prospective returns were very good, but because of the change in the vehicle. As a reminder, Dignity was and continues to be one of our highest conviction positions, on the basis that we think it has tremendous assets across its crematoria, pre-need funerals and at-need funerals that are structurally very attractive but are undervalued by the market. Perhaps in the Q&A we could talk about how I view the progress there. But so we trimmed that into the bid that we received, I think it was on the 5th day of the year. And EasyJet we trimmed, given the growth in our overall airline exposure, to allocate toward other holdings which we thought had as attractive risk adjusted returns but offered a diversification benefit. On the right-hand side, if you think of Meta, Flutter and Essilor Luxottica, they're companies we fundamentally like, but on our judgment, the prospective returns had fallen to the point at which we thought we could thoughtfully reallocate the capital. Prosus is effectively the holding company for Tencent that's listed in Europe and trades at a discount to its Tencent stake. We sold that when it performed well due to our concerns about ultimately where Tencent's margins would be, and that on a relative basis has been the right call. If you look at what we added through the year, we increased our position in NatWest. UK banks underperformed meaningfully in Q3, and that was down to effectively their deposit costs rising faster than their hedging. Their deposit costs rising quickly, and they're effectively hedging some of their assets at rates that are lower than spot. Ultimately, we think that's a timing issue, and so added to the NatWest position through the year. Alphabet's one that we effectively reallocated from companies like Meta, Flutter and Essilor towards. And that's because, in our judgment, it continues to have a tremendous market position in search. It's a natural monopoly, but it's also very well positioned in AI, which wasn't being priced into the stock, which was trading sort of 17, 18 times earnings with $100 billion in net cash. And then if you look at the new positions, there's a sort of broad church here. So Hargreaves Lansdown's a position we started at the start of the year. I wrote about that in our Q2 fact sheet. The reason we hold that is because effectively we think the market's pricing the moat to disappear, whereas actually its 42% share of the DTC market in the UK is firstly, we think, durable. So AJ Bell's the only real competitor it has, and that business was started in 1995. But secondly, they're very attractive features of the UK D2C market, which we think will structurally grow over the long term, but that are currently cyclically depressed due to all the headwinds that you would know about. BP and Shell, we have a small position there, but we thought from a portfolio construction basis, it made sense to have some exposure to energy at prices that became attractive in March and June last year. INA and Universal Music Group are two European holdings that we've introduced into the trust. So INA is effectively the monopoly owner of all airports in Spain. We bought that on close to 5% dividend yield. It should grow its earnings by 7-8% a year. So we see attractive mid-teens return for a stock that should offer very low risk characteristics. And if you look at Universal Music Group, there the opportunity was because AI was, for a very short period of time, I believe it was around May, priced to be a material risk to the business, and the stock fell to €18.50. And we thought that was mispriced. We really liked the duration of its music assets, its capital light model, and the scarcity of what it has. And subsequently, that stock's re-rated very nicely to €28. So this is the portfolio as it looks today. If you think about, to be honest, in some ways, these are somewhat arbitrary ways to bucket positions. But if you think about it, the way I look at it is the trust has effectively 35% in what I would call compounding franchises in the middle. It has about, again, another 30-odd% in pretty idiosyncratic positions where we see considerable value, but the drivers of which are sort of industry or market independent. And then at the bottom, what I would call capital cycle holdings, where it's really an industry thesis that is driving a view on why sector returns would rise. Albeit clearly you could put something like Frasers Group into the idiosyncratic, but it's helped by the rationalization and consolidation of the retail market. Coming on to macro, I thought I would do this one slightly quicker than I would have done in the last webinar or if we met in the past, and that's the reason being that I think our views are more consensus than they were at times last year. But I want to make a couple of observations about the UK market and rates and macro. So firstly, this is not trying to excuse suboptimal performance. Suboptimal is probably, let's say, poor performance actually, of both the market and, frankly, ATS in my opinion over the last 3 years. But just to point out how striking it is, so since the start of 2020, the FTSE 250 is down 1% in nominal terms, and that's effectively a real return of minus 22%. At one point last year, you'd lost a third of your capital in real terms investing in the FTSE 250, and about half our capital is invested in FTSE 250 facing companies. And you can see that effectively the S&P 500 and the MSCI World, of course, which is driven by the S&P 500 today, have performed much better. So the decline in the FTSE 250 is really quite striking if you think about it in real terms. And why does this matter? Is I think if you look across the UK market, what you can see is loss aversion is pervading investor behavior. And I think the analogy that Kahneman used from his study of New York drivers is quite illustrative, which is that when it's raining, New York taxi drivers earn more because there's more demand and fares surge. And when it's sunny, they earn less because there's less demand for taxis. Yet statistically, taxi drivers work harder when it's sunny and less when it's raining because they don't like the feeling of lost income on a sunny day, even though the price of their leisure is materially lower on a sunny day. And if you think about it, when it comes to investing, evidently that sort of feeling of loss aversion is why in stock markets you can be less attracted to prices when they've fallen, whereas in a supermarket, evidently if the price of something falls, you probably, all else being equal, want to buy more of it. And you can see this in examples like across the UK investment trust sector. And I'll come on and maybe in the Q&A talk on our trust discount and what we have or haven't done about it. But I'm just pointing out that trust discounts narrow when performance is good, and they widen when it's poor or the outlook is perceived to be poor. Whereas the reality is that prospective returns are probably higher at lower prices. If you look at the UK, again, I think this is increasingly consensus, but this would be a view that we've had is that I think there are a number of conceptions that explain why equity risk premium, and I'll show you how I measure that, is elevated in the UK. So I'll run through these, but there was a perception, a pretty significant perception through 2022 that UK inflation had idiosyncratic drivers that meant it was more sticky than in other countries. I think that's kind of proving not to be true. The experience is similar to other developed markets. The UK labour market is loosening like other markets, and there's certain timing effects. For example, our energy cap here that are sort of explaining that some of it was due to timing and not a fundamental difference. There were comments about UK GDP lagging peers. Actually, revisions showed UK GDP hasn't, and there are a number of European countries, particularly Germany, that have lagged the GDP performance of the UK. Politics, in my personal view, this is actually the most credible risk. You can look at what's happening in maybe it's not called politics, maybe it's UK institutions. But if you look at what's happened in the auto loans issues for UK banks, it's clear, in my opinion, that there's been unforeseen risks to profits from regulation. I think house building is another example there in terms of what's been happening on planning. And in my opinion, the only good news here is that at least there's less uncertainty in the political environment than there has been for at least 4 years. And then the last point is confidence has clearly been impacted. And you can see that across any economy. Hard data, so actual employment, has been a lot better looking than soft data like confidence surveys. And in my opinion, that had a lot to do with inflation. And the turn in inflation and real wage growth turning positive is very helpful to release effectively the animal spirits that have been lacking in both the consumer and the corporate sectors. I'll flick through these very quickly because the more important point is what does it mean for equity valuations? So if you see here, again, the inflation experience across developed markets is actually looking pretty similar. There are exogenous factors that have corrected, for example, containers. and what happens in the Red Sea might lead to a temporary issue, but again, it's not a structural inflation problem, which is what would matter for rates and therefore equity values. Similarly, electricity prices, in October 22 at the peak, the gas equivalent value in oil terms was $400 a barrel, and there were some concerns that would persist, but it hasn't. And then, in my opinion, a really important one is it's down to money supply. So the only people that got this right in 2021 predicting inflation were those looking at money supply. And money supply has reversed very sharply. It's falling across the UK, US, and Europe. And really, it's services inflation that is the outlier. But in my opinion, it's pretty logical to understand the reason for why that is a somewhat more lagging indicator than goods inflation. And here you can see, again, there are leading indicators which continue to suggest that inflation is falling. If you haven't looked at Truflation, which is a sort of third-party service that tries to replicate CPI based on current metrics, it indicates the UK inflation is currently about 2%. And then I thought this was a very interesting quote from Rob Perrins, Barclay Group. It's a stock we hold and a company which I really admire. And in December, he just said very clearly, unpromptedly, the Bank of England is keeping rates too high for too long. We're a leading indicator and we clearly see deflation. Another one here, yes, is the labour market, which there were sort of Brexit-specific reasons for explaining the UK tightness, but I don't think that's what's playing out. And again, as commented, consumer confidence has risen quite strongly off the lows, but as you can see, is at historically depressed levels. This is what I actually think matters for your holding in the trust, or if you hold other UK equities. So even if you didn't want to invest in the trust, this is why I would try and posit that there is a good time to be investing in UK equities. And this is just to show you that you can see that real bond yields went from effectively being highly positive to very negative. So, in 2021, someone was willing to invest in a UK gilt that would guarantee them a 2.5% real return, a negative 2.5% real return. So just acknowledging that you will lose your money in real terms. If you look at equities, the equity yield in the all share is actually 10%. And it's been lower than this appearance in the past, and it's been higher at times of crisis. But if you subtract the two, you get what, in my opinion, is a decent measure for equity risk premium. So that is how much are you being compensated over inflation-linked returns for the risk that is inherent investing in equities. And today you can see in the UK that that's about 9 and 10%. You can see in the 90s when rates were, in quotes, normal, that was 5%. And evidently, there are differences in the composition of the index, or the prospects for Shell might be different today to what they were in the 90s. But in broad terms, you can see that you are being compensated for those risks at quite a high level. If you were to compare this to Europe, Europe is down in the 6%, 6.5%. If you were comparing this to the US, it's materially lower than that. Before I just come on to portfolio observations, I thought I'd just say a couple of things about AI. Clay Christensen came up with a sort of framework for thinking about technology. I think it's a very useful one for AI. And what he's pointing out is that you can effectively categorize something into a sustaining or disruptive innovation. And the implication being that what it does to incumbents or entrants, that categorization is illustrative, is illuminating. And here, what I think is quite clear is AI is unlike the internet, which, take for retailers and e-commerce, effectively fundamentally rewrote distribution channels, which required large fixed costs and were hard to change. In contrast, AI, in my opinion, is led by data and is much more likely to lead to efficiency gains for both incumbents and any entrant that is able to embrace that technology better than an incumbent. So I personally think that the impacts of AI are likely to be more broad and more fundamentally less destructive than the internet was for a variety of industries. So if you look on the left, in my opinion, something like financial services should, over time, have a clear efficiency benefit from automating straight-through processes. Companies like airlines, if you think about the enormous saving that you could make if air traffic control was not covered by people who strike very often, and actually done more efficiently through automated routing networks, that there'd be a material cost saving for the industry. Now, these gains could be homogenous and therefore competed away. That's entirely possible. But in my opinion, it looks much more encouraging than it did for the internet. If you look at what I think is in the at-risk category, it's things. So, for example, what impact will AI have on drug discovery? Clearly, something that is changing. It's not clear whether it's positive or negative. We had a very interesting call with the head of R&D at GSK about this. But something like, say, call centers are one where you could see that role being replaced entirely, or not just call centers, but if you think of support services that are offshoring. And advertising, similarly, I think is a fast-changing market, and therefore there is a risk of change. And on the right-hand side, there's some areas where I think it looks unlikely that AI will have a material impact. So, for example, on infrastructure assets, we have 2 in the fund. I can't see how AI will lead to a material direct impact there. I thought I'd talk about a couple of stocks in the portfolio before leading to maybe a comment or two about positioning, and then stop for questions. And the reason I think it's important to talk about portfolio holdings in a bit of detail is because we have an unusual process, I think. And clearly the concentration of the fund means that, in my opinion, it's really important that you understand the conviction that's expressed in our sizing. So Frasers Group, I'll touch on this one briefly because I think I would have done this in the last webinar if you listened to it. But effectively, it's great. In my opinion, it's a great misunderstood company with an almost monopolistic-like position in sportswear retail in the UK. If you include athleisure, it's more of a duopoly with JD Sports. But the reality is if you need to buy football boots for your kids, there are just very few other places you can go. It's growing in the luxury market. It acquired Matches in December, and it's consolidating that position. And it's really come from a sort of position of zero there in the last few years. It has a strong own label offering. So one thing that I think is never sort of not fully understood is that nearly 40% of the sales in Sports Direct itself are own label, and that gives it pricing power. And then what's really important, which I won't go into too much today, is the capital allocation and the way the business is managed, which has allowed it to effectively survive in a retail market that is, all else being equal, a pretty risky industry because it changes and it's hard to get it right. And on capital allocation here, if you look at it, the business is just enormously cash generative. It repurchases a significant amount in its own shares, but it's always investing in the business, be it through strategic stakes, automation, and that's why you don't see a dividend, is because the company is always reinvesting its capital in its business at what I perceive to be quite high rates of return. And if you were to look in December, so the stock's down 12% year to date. It had a good run into the year end, but I think it's actually just quite easy to illustrate what the sort of upside, how you could make sort of 30% over 3 years in Frasers Group. And that's through operating profit growth of 9%. It's sort of what it's done historically. It's got certain avenues to achieve that currently that it didn't historically. So things like its relationship with Nike significantly improved, but it's also growing very quickly in luxury, which is currently a low margin business for it as it consolidates its market position. And then, the stock today is actually on less than 9 times earnings. It's on 8 times earnings. Next trades on 14, 15 times earnings. And Frasers actually, in my opinion, has a more durable competitive position through its brand ecosystem. But it's also got some upside potential that a company like Next wouldn't. So, for example, in financing, Frasers is just getting started. And so if you put that together, that's why it remains one of our largest positions, because we're very confident in the management team and the company in achieving the performance we expect, but also it's priced in a way that we should deliver strong returns if it were to achieve that. Plus 500 is one which I haven't talked about before, but I thought I would because we've held it since 2015. It's a top 10 position. And in an odd way, kind of, in my opinion, illustrates why there are companies in the UK that are very undervalued. So if you look at Plus 500, I guess the key insight in this investment is CFDs are not a fantastic market. There's clearly a degree of consumer harm in CFDs because people can misuse the instrument, and that's why the regulation has increased over time. But what's really important is Plus 500, I think, is an advantaged business because of its technology in Israel, its staff and its mindset and its management team. And what that means is that it's grown very significantly in this market from a position of zero. It continues to operate in CFDs, but it is diversifying into other industries, all of which mean that earnings are positively correlated with volatility, which means that it is effectively a volatility hedge in the portfolio. And as I'll show you here, the financials are really attractive. So if you look here, this is why I think it's actually a really different company to an IG index, which is a good business, and a CMC Markets, is that its fixed costs are 7% of revenue relative to peers. And that's what happens if you start in Israel with no legacy tech stack, and you can achieve what your competitors do with a fraction of the headcount. This is the point I was illustrating on historic earnings. They're highly correlated to markets. That's very attractive because effectively, you know that if the markets, and this happened in 2020, 2018, if the markets are having a volatile time, Plus 500 will effectively see a boost to its revenues. Usually in the market, volatility hedges are very expensive, whereas Plus 500, in my opinion, is a volatility hedge with a 15% earnings yield, 15 to 20%. You can see here that the company's return on capital, not making any adjustment for excess cash, has been approximately 90%. It's much higher than that in years where it makes effectively excess profitability, but it's not low in so-called fallow years. And what that means is it can grow whilst giving you back the capital. So it's distributed over 2 billion to shareholders, which is approximately the market cap today, and reduced its share count by 29% over the last 5 years. And importantly, since its IPO, Plus has compounded at a rate of 41%. And that is despite the fact that today it trades on 2 times book and 5 times earnings, which in my opinion illustrates that if you buy a fundamentally good business, you don't need to depend on the market for a re-rating, because ultimately it comes through in the capital efficiency which generates earnings, and that is distributed to you as cash. This is possibly my favorite slide, which I read a book called What I Learned from Investing about Darwin, which is is from a quality investor based in India who is comparing investing to Darwinism, and he had a very interesting observation on how on the distribution of stock market returns and how important it is to be a buy and hold investor. And I just thought with Frasers and Plus, which are 2 of the Trust's largest holdings, I ran the same analysis and I thought it was really quite interesting. So if you look at the bottom to start off, we've held Plus for 7 years, Frasers for nearly 8 years, which is nearly 1,000 trading days. And 2,000 trading days. And on 50% of the time, the stock's gone down. So, you know, it's literally 50-50 whether tomorrow is a positive or a negative day for these stocks. And in that period, Plus has returned 251% relative to the FTSE 250. Frasers has returned 111%. 90% of those gains has come from effectively less than 1% of the time that we've held them. So 8 trading days in the case of Frasers, 19 trading days in the case of Plus. Now, this could generally, you know, I assume if you did this analogy for something like Relics, where the returns have been quite linear, it would look far less skewed than this. But it's why it's quite an important point of the approach to understand why effectively we don't try and time things, and why when we find a structure that we are very positively disposed to, we will not try and time sizing and we will let winners run. I thought I'd talk about a couple of other ones. Nintendo is one which has been in our top 10 for the last 4 years. I've actually held it since 2013 in my investing career, and it's been in the trust since 2016. I thought it'd be worth illustrating this one. I could have done Google because it is an overseas investment. A key characteristic of the trust is we have nearly 25% of our portfolio invested in overseas companies. And I thought I'd just explain the thinking behind why we think Nintendo is such a compelling company. So the first observation I'd make is it has really unique intellectual property. Pokemon on the left, you can see Pikachu, is the most successful franchise in merchandising history. On the right-hand side, Super Mario, who's been going since the 80s, is consistently one of the most popular IPs in the world. Nintendo has a disproportionate share of the top 20 games of all time. And really importantly, why do I say unique? Is because if you look at their approach to media, it's things like you will never find a drop of blood spilled in a Nintendo game. And so its content is actually appealing to all age groups and all geographies. So if you take China as an example, which doesn't like violent games or will censor them, Nintendo's IP can work there when others such as Call of Duty don't. I think it's underpenetrated globally, and I'll illustrate that. And it's been a beneficiary of effectively a slow move, in its case, to embracing digital distribution, which is very positive for margins. And so I think, and the other point is the company is very conservatively run. So it's got $15 billion in net cash, which has been growing, and it has opportunities to extend its IP. But the key insight really, I think, in this investment is console cycles are cyclical, and therefore earnings fall and rise. But the reality is that it's a misvalued equity because the duration of the earnings that come from its IP is really quite incredible, as illustrated by the fact that Mario's been around for over 40 years. So this is the point about this is an illustration about the point of digitalization. You can see on the left-hand side, its digital revenue, software revenue has grown really sharply recently. So this is doing things like not buying a physical game, but downloading it instead, or purchasing an online expansion pack. And on the right-hand side, you can see it's seasonal because in Christmas, it has a disproportionate share of physical games. But you can see that the digital sales ratio has consistently trended over time, and its gross margins have risen from in the 40s to nearly 60%. The Super Mario Brothers movie is an interesting one, which I think highlights the power of the franchise. So this was a movie that initially had a Rotten Tomatoes critic score of 50%, i.e. the critics didn't like it. And it's gone on to be the second most popular animation of all time, might become number one. And it's been seen by 169 million people. Why does this matter for Nintendo? Is if you look at Nintendo historically, what it's done, and it's been changing, is it's monetized the popularity of its IP primarily through its video gaming franchise. And today it has about 110 million active Switch users. But if you look, over 900 million, there have been over 900 million unique downloads of its app on the mobile, and over 330 million people have registered for a Nintendo account. And so, in my opinion, as the company effectively explores new avenues for people to interact with its IP, and as it becomes more flexible in how it can monetize that IP, the upside to earnings is quite material. And if you look at it today, for what I think are really attractive characteristics, the company is attractively valued. It's on sort of 15 times EV/EBIT. 2024 profits, in my opinion, are a cyclical, probably medium or low point. And therefore, I think the compounding potential from here is really quite attractive. I'll touch on house builders in a second, because I'll only touch on a couple of points here. I think the investment case is kind of pretty well understood, which is that there are not enough homes in the UK, and in a poor year like last year, that issue is only worsened because affordability means demand is suppressed. And even before you talk about cladding or planning, which is the sort of regulatory issues impacting build, the house builders didn't build, I think they built 120,000 homes last year. And so you have this accumulated housing deficit that is being compounded each year. And you have these businesses which in the market size are enormously cyclical and effectively halve every time the UK has a panic, whereas their business franchise value is preserved by the fundamental need for housing, which doesn't change, and which is protected by the fact that it's very hard to do. So it's not easy to gain planning permission, have enough sites, and operate efficiently to generate the margins that the large players do. I think a really important point in this sector is there's negligible obsolescence risk. If you look across the market, there's so many areas where you can debate whether the moat is shrinking or rising because of technology or consumer change. Here, there is none. And so in some senses, whilst the market obsesses about cyclical risk, I think it misses some of the sort of positive characteristics that are inherent in the sector. And just to point out, we've got 5 holdings here because we've actually also got a holding in a Scottish house builder called Springfield. In my opinion, because the returns in the sector are reasonably homogenous, Berkeley Group's an outlier in that sense. It's not really a house builder. You can diversify across without giving up across the sector without giving returns. But so we didn't really add to the positions last year because we already had a very, very large position. But our conviction in it and continues to be really quite high. And this is the supply and demand deficit illustrated. And if you look on the right, this chart I think is very interesting because it needs to be acknowledged that net migration is only making this worse. And so the situation is quite compelling. And the stocks are not even pricing what you would get if you built out the land bank, which is what this slide illustrates. EasyJet and Ryanair, I think I'm not going to spell out the whole investment case here because I think you will understand it, and we would have talked about it before either in presentations or fact sheets. It's clearly been painful holding those businesses through a pandemic when their profits were effectively evaporated and their cost base incurred losses. What I'd like to say is more about the here and now, which is that in my opinion, these stocks which are trading materially below the valuations that they were pre-COVID, so that's what this slide illustrates, in no way reflects what the industry setup is. So if you look at EasyJet, and we went back a decade ago, Wizz Air was a new entrant in the industry, and it grew considerably. And it could grow because there was an opportunity to, and Bill Franke took his capital and invested it. Now, EasyJet's quite protected from that growth because it operates in slot-constrained airports where Wizz can't compete against it, but it's evidently a negative that capacity was filled by an operator other than EasyJet. If you look at the outlook today, effectively you have a company called Pratt & Whitney produces GTF engines, which have a reasonable share of narrow-body planes. There are material problems there. Boeing, which is probably better publicized, is having issues with almost all of its planes and can't ramp up narrow body plane capacity. So even if you were Bill Franke today and you wanted to get going, you wouldn't get any planes delivered till 2032. And so actually, I think the logic for these stocks trading at the multiples that they are today, given the industry's supply and demand dynamics, is I think illogical. And here, this is a chart from the Ryanair Capital Markets Day. Ryanair held a Capital Markets Day for the first time in 10 years. We attended it in Dublin. And what I think is very interesting is, again, this is logical, is if you look in 2024 compared to 2019, there effectively be roughly the same level of capacity that there was then. And yet demand grows every year. And it was pent up during the pandemic, but structurally it grows as a function of demographics, wealth accumulation. Traffic and travel has consistently grown above GDP for several decades. And so that's why if you combine that with the supply deficit, I think means that the backdrop for investing in airlines, which frankly has been a challenging investment for us, but also historically, looks better today than it has done in a very long period of time. NatWest and Lloyds, I think the investment case here is pretty well understood. And so what I would just talk about is really this point, which perhaps is understood, but in my opinion is mispriced, which is the fact that the companies, unlike many European banks, are not achieving the yield on their assets that they would be if they weren't hedging. And therefore, you can look today and see that effectively the income tailwind to come from this being repriced is almost as large as their profits before tax last year. Now, that doesn't mean to say I think earnings will double, because what will happen is deposit margins will shrink and mortgage margins may be lower if liability margins are higher. But the key point is that banks really should have benefited from rates on deposits going from 0 to just non-zero. Forget about sort of 5%, although or call it 3% today, and they haven't. And in my opinion, that's a timing impact. And here again, if you look at NatWest in particular, What's quite important if you're looking at the analysis is, so compared to December 2019, NatWest stock is down 16%, the share price. But if you consider that the shares outstanding have shrunk by 22%, the actual market value of the business is down 34%. And yet NatWest's returns have risen from 8% to 16%, its EPS from 22p to 45p, and the stock is trading on less than 5 times earnings. There are a number of risks in banks, and I acknowledge that. There are regulatory risks, credit risks, liquidity risks, and I wrote about it in our Q4 quarterly. But in my opinion, if you look at effectively the cost of equity implied in banks, I think you're receiving a pretty significant compensation for those risks. So just to round up on all of this, I guess the easiest way to put it is macro, in my opinion, is likely to move from a material headwind to general risk assets, but also the UK market. And within that, I see very high prospective returns across the portfolio, both in those stocks where macro is evidently a driver of earnings, or a favorable macro environment is helpful for earnings, and those that are not. And so overall, I think we've learned from mistakes that we made in 21, 22. We've changed our process in certain ways that I think have been demonstrably additive to our stock picking style. And therefore, as indicated by my transactions in the trust over the last year, I hope and expect prospective returns to be compelling from here onwards. Great. I think I'll just stop there.
Kartik, thank you very much indeed for your presentation. Ladies and gentlemen, do please continue to submit your questions just using the Q&A tab situated in the right-hand corner of your screen. But just while Kartik takes a few minutes to review those questions submitted today, I'd like to remind you the recording of the presentation, along with a copy of the slides and the published Q&A, can be accessed via your investor dashboard. Kartik, as you can see, we've received a number of questions throughout today's presentation. Thank you to all the investors for submitting those. I just ask you just to click on that Q&A tab, and where appropriate to do so, just read out the question and give your response, and I'll pick up from you at the end.
Yeah, sure. I'll start from the first one here. Could the new car finance scandal be the new PPI for banks? Okay, there's a long and a short answer to that. New PPI scandal. So can it be a cost for banks? Yes, it can. If you look at how it's been priced into the bank, should it be, is I guess a question for the regulator. So if you asked me, and I've had one of these loans, I think the extent to you could argue that there's a degree of socialization of profits in the way that this is looking like it's going down, but that doesn't matter. And it contrasts with what Jeremy Hunt said last week about trying to address the undervaluation of UK banks. Importantly, is it going to be as damaging? So PPI dragged on for years. Here, the FCA have said, stop your complaints. We're going to deal with this at once and make a judgment. That's going to significantly reduce the cost of processing it, which I think were about a third of the overall PPI costs. And then secondly, the scale is lower. It's cars, not mortgages. And importantly, if you're trying to then go, okay, Kartik, just try and think about what's the worst case scenario for Lloyds and is it priced in the stock? I'd say this. So if you looked in aggregate, banks, UK banks only provided about half the financing for cars. So half of the damage will land up on original OEMs for the cars. So it's not about the UK banks. And then secondly, if you look at something like Lloyds, its average market share from 2007 to 21 was about 11%. So then let's take, in my opinion, a reasonable worst case scenario looks like 13 billion in aggregate. So Lloyds would have a cost of about 1.4 billion. So you then say 1.4 billion over, call it 3 years. Let's say that's 300 million pounds a year. There's a tax, it's tax deductible, so it'll be less than that. What does that do to the prospective returns? In my opinion, from the way I look at things, it drops the prospective returns by 2% on a number that is, frankly, over 30% in Lloyds' case, because I would expect a re-rating from 0.8 times book when you're generating a return on capital that should be in the mid-teens. So it is potentially a redress liability where one can debate whether whether it's justified or not, and it's a cost. But I think the banks are in a very strong position, and I don't see it meaningfully impacting the return potential from here. Yes. So do you see the private holdings impacting the return profile? Can you talk through the strategy? Okay. Yes. Sorry. I've stopped putting as much attention on this because they are about 8% of the capital today. Let me talk you through this. There are two significant holdings. Reaction Engines is a 5% holding. You can see that up there. That is effectively a intellectual property company based in Oxford, where the largest shareholders, BAE Systems, Rolls-Royce, a sovereign wealth fund, and then Baillie Gifford. So it's quite a large company. And we will effectively look to realize value when we can. You can see Edinburgh Worldwide Investment Trust holds it. I would note that they hold the valuation of that company at a reasonable premium from what I can see to where we hold it. And we would look to realize our holding as and when we can. There has not been an opportunity to do so because the company has been seeking primary funds. M+1 Singers is a 3% holding in the company. That's a sort of well understood investment bank. It has a significant cash balance. We value it on 1.4 times cash. Numis, by example, was taken private by Deutsche Bank at 2.5 times book. Now, Numis has certain advantages over Singers, but historically it's been a conservative valuation that we've held it at. And even this year, it'll probably produce an 8% dividend yield for us. And you can see that there's been consolidation in that sector. So I think the probability of us realizing that holding is reasonably high. The pricing will depend on market conditions and who's buying it. And we are, generally speaking, if I take a step back, we would like to have zero in private companies. We would think it'd be better for our overall liquidity profile. And we think our skill sets in public markets. So our ultimate objective is to realize all of these in a way that's value accretive. And then, sorry, let me just, I was going to say one more thing. Does it impact the return profile? Yes, I think it does. So I give you an example. When I think about a portfolio weighted IRR for the whole portfolio, I have a zero return for those stocks. And we'll be very pragmatic about realizing them. So yes, I think it's a disadvantage that we have. What is the universe of stocks you have for selection? How do you filter these to form the portfolio? So the universe of stocks is primarily in the UK. And just to be clear, so we go overseas when we find a stock that we think our investment process can fit in, and that we could not buy in the UK, importantly. So we won't go and buy Philip Morris because we don't like bats. But it's something that provides a diversification or investment construct that we couldn't find in the UK. And effectively, the universe of stocks, so let me talk about the UK. In the UK I effectively have an understanding of all the businesses, because it's not all the businesses that we would find investable, in terms of can we understand the risk? Can we understand the return profile? And we effectively filter through what we think is in our sphere of competence. And then usually we will have a list of stocks where we size the return, and there's either a risk that we're struggling to isolate, or the return is not sufficiently high to compensate capital reallocation. So if I had to give you examples today of stocks that aren't in the portfolio, but that could be, it would be things like London Stock Exchange, which was last year and has been at various points, Auto Trader, Rolls-Royce, Wise, which we actually have a small holding in, National Grid. So effectively we filtered down into a sphere of competence list, and then we have effectively a bench of stocks that we would like to have in the portfolio or not. And then we have select overseas holdings that fall into that too. And we tend to be opportunistic in both respects. Hope that answers that question. The trust has at times been months on a discount of 20. Yet there was no buyback activity. It doesn't seem that the company is providing any message to the market about the discount level it might look to defend or target. Okay. So I think the first thing to say here is to apologize for making a mistake, because what we did was, if you were to look back at the last time we had a tender opportunity, what I effectively put forward was to try and find a way to allow us to buy back shares in a range of discounts that would mimic the tender, so that you, the investor, could choose when you want to sell, as opposed to a tender, which is one and done, right? And effectively, what happened is that process was very hard to implement when two things happened: is that NAV declined significantly through the end of 21 and 22, and then secondly, discounts in the sector widened significantly, and so effectively it would be very hard to defend the discount that we were aiming to do. So I want to firstly be upfront and say I think we made a mistake there. What have we subsequently done is, in our judgment, so bear in mind that there is an opportunity to vote on a tender in September, and bear in mind that we are all shareholders here at Artemis are highly aligned with you. Is our view was the impact of buying back shares, the positive impact that had on NAV accretion was outweighed by reducing the overall liquidity of the trust, especially bearing in mind that shareholders have the opportunity to vote in the tender in less than a year's time. So I hope that explains why we haven't been buying back stock since, I think, April last year, and explains why our policy has changed from what we set out to achieve. And hence, could that change going forward? Yes, but in my opinion, I have certain views and learnings from the effectiveness of buybacks for trusts at certain size and even larger sizes, and whether or not you should let the market determine the discount rate. So I think that's that. Then I have a question of, there's a significant overlap between the portfolio and that of Aurora. Yes, I've had this question before. So what I point out is, so Gary Shannon is someone I have a relationship with, admire his investment style, and we have similar mindsets towards long-term value investing. Evidently in things like Dignity, I originally, our vote was imperative for him to become CEO of the company. But what I'd point out, which I have done before, is the overlap, I think, is about 30% of NAV. Investors with similar mindsets often end up in similar securities. But their portfolio is significantly more concentrated in a handful of stocks, which you can see in our top 10. But if you look at our overall portfolio, we have a third of the portfolio overseas. We have 35 stocks. And that explains why the performance is also different. I think that, so yes, there are similarities, but ultimately, and I hope today gives you an insight into it, is, we have our own investment style and approach to stock picking.
Carter, thank you very much indeed. You have addressed all those questions that have come through, and of course any further questions that are submitted, you'll have the ability to review those, and we can publish responses where appropriate to do so. Perhaps before redirecting investors to provide you with their feedback, which I know is particularly important to you and the team, could I just ask you just for a few closing comments, please?
I hope to have covered it all. I think that hopefully in a less macro dominated environment, I think our approach to stock picking might generate better returns. I hope I have been able to transfer some of the conviction I have about the underlying portfolio holdings to you, which informs my judgment that returns will be attractive from here. I guess that is that's the last message I'd leave you with.
Fantastic, Carter. Look, thanks indeed for updating investors today. Can I please ask investors not to close the session? You should be automatically redirected to provide your feedback, and all the team can better understand your views and expectations. This will only take a few moments to complete, and is greatly valued by the company. On behalf of the management team of Artemis Alpha Trust PLC, we'd like to thank you for attending today's presentation. That concludes today's session, and good morning to you all.